Welcome to this explainer. Today, we are doing something really fun. We're putting AppLovin through the absolute ultimate valuation gauntlet. We're going to step into the shoes of an expert investment analyst, and we'll use the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, alongside a rigorous discounted cash flow model to perform a complete top-to-bottom stock analysis. Our goal? We want to figure out if this high-flying AI software stock is actually worth its premium price tag. Let's get into it. Here is our roadmap for today. We'll start with a snapshot and the Buffett lens, move on to the Peter Lynch lens, check in with Ben Graham, build out our DCF valuation model, look at Wall Street's alternative models, and finally, synthesize it all for our final verdict. All right, Section 1, Snapshot, and the Buffett lens. Does this business actually have a moat? So when Warren Buffett looks at a business, you know the drill. He wants consistent earnings, high return on equity, and debt that isn't going to sink the ship. And wow, looking at AppLovin's Q1 2026 financials, we are literally seeing video game cheat code numbers here. They generated $1.84 billion in revenue, which is up 59% year over year. Assuming industry standard debt and ROE levels based on their tremendous cash generation, the real kicker is the conversion. That revenue turned into $1.29 billion in free cash flow. That is an amazing proxy for Buffett's favorite metric, owner earnings. For an enterprise software company turning over 70% of your top line straight into free cash flow, that's almost unheard of. It is the ultimate standard of efficiency. And this setup perfectly illustrates a classic Buffett-style economic moat. First off, their proprietary AI technology, the Axon 2.0 engine, acts as a massive competitive advantage. It actually uses contextual signals rather than user-level identifiers, which completely sidesteps Apple's strict iOS privacy restrictions. Then, look at the management team. CEO Adam Faruqi intentionally hires people with a chip on their shoulder, maintaining this hungry, driven culture even 14 years in. On top of that, they are incredibly shareholder-friendly. They use their massive cash generation to buy back a staggering $1 billion of their own stock in just the first quarter of 2026 alone. So the business quality is undeniable. Buffett would absolutely drool over those owner earnings and the aggressive share repurchases. However, given the current stock price hovering right around $527, Buffett, who is famously disciplined on price, would almost certainly demand a steeper margin of safety before actually pulling the trigger. It's a wonderful company for sure, but maybe not quite at a wonderful price for his specific taste. Let's shift gears. Section 2, the Peter Lynch lens, categorizing the growth. Now, unlike Buffett, Peter Lynch is way more willing to pay up for aggressive growth. Applying his famous categories, Lynch would immediately label AppLovin a fast grower. While our baseline data doesn't detail the exact insider buying or institutional ownership percentages, which Lynch does like to monitor alongside a strong balance sheet, the operational story here is remarkably clear. AppLovin isn't just resting on its laurels in mobile gaming. In June 2026, they opened up their Axon ad engine to the general public as a self-serve platform specifically targeting e-commerce brands. And get this, management estimates this non-gaming advertising market is 5 to 10 times larger than their current gaming market. The crucial point is this 59% year-over-year revenue growth figure. Because they're tapping into a vastly larger total addressable market in e-commerce, that growth runway is just massive. When you pair that 59% top-line growth with their blistering expansion in earnings per share, their PEG ratio, price to earnings relative to growth, remains highly attractive. For a Lynch-style buyer, the incredible growth trajectory completely justifies the current entry price. All right, on to Section 3, the Ben Graham lens. Let's test that margin of safety. Now we're going to subject AppLovin to the toughest test of all, the ultra-conservative Benjamin Graham checklist. Graham cares about present-day assets, not a shiny AI future. Now, AppLovin actually does quite well initially. It passes on adequate size with nearly $2 billion in quarterly revenue, and it passes on strong financial condition and earning stability thanks to all that massive cash flow. But it completely faceplants on his strict price-to-book and price-to-earnings constraints. Graham wanted stocks trading near or below their actual book value, and let's be real, software companies basically never do. To put an actual number on it, we can use Graham's famous intrinsic value formula. We calculate the company's book value per share at roughly $7.03. Then, we take Q1's diluted earnings per share of $3.56 and annualize that out to $14.24. We plug those figures into the formula, the square root of 22.5 times the EPS times the book value. The math yields a Graham fair value of just $47.46. At a stock price around $527, yeah, that means for a pure Graham value investor, there is absolutely zero margin of safety here. Graham would view this as entirely speculative and would run the other way. Moving right along, Section 4, DCF Valuation Model, Projecting Future Cash Flows. Stepping away from pure historical value, let's build our own 10-year discounted cash flow model based on management's wildly ambitious path to a potential $70 billion revenue target. To be prudent here, we're going to model this based on earnings per share rather than raw free cash flow. We want to smooth out any potential heavy capital expenditures, like them having to buy massive server hardware to support their AI expansion. We project a 15% average EPS compound growth rate over the next decade. Why 15%? Because while they're growing at over 50% right now, the law of large numbers will eventually catch up, so we're blending it down. And we'll apply a generous 4% terminal growth rate to calculate the company's perpetual value after year 10. This sensitivity table shows the results. By varying our weighted average cost of capital, which is essentially our required rate of return to discount those future cash flows, and our terminal growth rate, you can see a whole range of outcomes. Under our baseline assumptions of a 10% WACC and a 4% terminal rate, our fair value lands around $464. This tells us that at $527, the current price is trading at a slight premium to a very reasonable fundamental model. You're definitely paying up a bit for the execution risk. Section 5, Alternative Valuation Models. Wall Street Consensus. Let's pivot for a second and see how the pros on Wall Street view AppLovin using alternative valuation methods like comparative multiples and forward-looking projections. Looking at data sourced from AnaChart, which represents the targets of 18 different analysts, the absolute lowest price target on the street is $515, which is basically exactly where the stock is trading right now. The highest target is a massive $860. That makes the average target roughly $685, which represents an almost 30% upside from current levels based on their collective models. And this chart really just perfectly illustrates the overall market sentiment. Almost 91% of these analysts are screaming buy. Wall Street is heavily banking on AppLovin successfully penetrating that massive e-commerce advertising market with their self-serve Axon platform. They clearly believe the growth story is far from over. All right, Section 6, Synthesis and Final Verdict, bringing it all together. Okay, we have officially run the gauntlet. Here is your ultimate scorecard. Benjamin Graham absolutely hates it and gives it a hard SEL. Warren Buffett, he respects the fantastic moat and management, but his strict price discipline makes it a hold. Our own 10-year DCF model also suggests it's a hold, trading just slightly above fair value. But Peter Lynch and the entirety of Wall Street, they are aggressive buyers, firmly believing the future growth fully justifies the current price tag. So, the blended verdict? Look, AppLovin is undeniably a fundamental powerhouse. That 70% free cash flow margin and their massive expansion runway into e-commerce are incredibly strong pillars. But you're paying a premium for that execution. The stock is practically priced for perfection. This makes it a strong hold for conservative, valuation-first investors, but a really solid buy for growth enthusiasts who believe the company can actually hit that $70 billion revenue milestone. So, I'll leave you with this final thought to ponder as you build your own thesis. In this new, wild age of artificial intelligence, is blistering, highly profitable growth worth paying a massive premium for today? Or do the ancient, unbending laws of the margin of safety still rule the market? Thank you so much for joining me on this explainer, and as always, keep doing your own research.